run through the presentation, and I'll just keep an eye on the lobby and admit anybody who comes in the next a little bit later. Okay, over to you, Jonathan.
Good afternoon, everyone. Like Vicky said, my name is Jonathan Loughran. I'm a chartered financial planner, and I'm one of the financial planners here at Prismatic Wealth. So today I'm going to give you a quick, hopefully half an hour, quick whistle-stop tour about making the most of your cash. It seems to be quite a well-attended seminar, and I imagine that's because over the last few years, cash rates have plummeted, and getting a decent return on your cash savings is becoming ever more difficult. And I want to also discuss as well a little bit about rising inflation. Cash is only worth what the interest rate you get after the rate of inflation. So it's kind of one of those things that's been in the news over the past few weeks. So I'll be kind of explaining how you can make the most of your cash and how inflation would impact that. So as always, you have to start with our disclaimers. So nothing in this presentation is financial advice. It's for information purposes only. I will talk a little bit about investments later on in the presentation. You just got to be aware that capital is at risk and performance can go up or down. And any tax calculations that I do are based on the current circumstances as we understand them, but they may change in the future if anyone's watching this kind of afterwards. So a quick agenda for today. I'll start by talking about the types of cash account that are out there. We'll move on to look at the current interest rates. We can't talk about cash without discussing the Financial Services Compensation Scheme, which protects your savings. We'll go through some of the benefits of holding cash and also some of the drawbacks as well. We'll talk a bit more about cash and inflation risk, which is going to be a definite issue over the next few months. We'll also talk about the alternatives to cash and the risks of holding other things that are cash-like or maybe more investment-based. And then at the end, I'll be happy to take any questions and answers that people have if anyone would like to make any comments as well. So I'll start by talking about the types of cash account. This may be relatively familiar to some people who've kind of managed their own cash over a number of years, but I think it's good that we go over some of the different types of accounts and some of the kind of common misconceptions. So the first type of account is instant access. So this is probably, you probably all have a savings account and it's probably an instant access account. These are the most flexible accounts. You can make withdrawals anytime and of any amount. But because they are flexible, they also come with the lowest rate of interest. And at the moment, that is very low. Some people, it's pretty much nothing. You can withdraw at any time. One of the benefits of instant access accounts is if you do withdraw any of your capital, there's no loss of interest. You'll get interest up to the day you withdraw it, and anything left in will continue to accrue interest. Rates are usually variable, so that means the bank you're saving with can change the rate of interest on that account, given a level of notice. So while it's very flexible, you can often open a new instant access account and find that the variable rate can move quite low quite quickly. So this is quite common tactics for banks to do to attract new money. They will give you kind of a nice high rate to begin with, and then after a certain period, they will then use their ability to use the variable rate to lower that rate and hope that you don't move your money elsewhere. Some bank accounts are now, some savings accounts, sorry, are now offering bonuses for several months. So they will say, we will guarantee that you get an interest rate of 0.5%, and this bonus is guaranteed for a certain period. So that kind of acts as a floor for a set number of time on instant access accounts. This is good because you know when you're moving your money into that account that you're going to have that bonus for a fixed period. So you know that's kind of a floor on the interest rate you're going to get, regardless of what happens to the variable interest rate on the account. These are probably the most common types of accounts. So these are probably the types that you've come across the most and you probably hold yourselves. The way this is going to work is I'm kind of going to move from the most flexible and accessible accounts, and then you're going to find that I move to kind of less flexible accounts. The benefit of having a less flexible account is you normally get paid a higher interest rate. So if you want a higher interest rate than an instant access account, and you are willing to potentially tie your money up for a little bit longer, the next type of account you might look at is a notice account. Not quite as popular as the ones were, but there are still a fair few around. So notice accounts, you can request access to your cash at any point, but there will be a period where the bank will not pay this out to you. So this is your notice period. So I'll use an example of a 30-day notice account. Today's the 1st of the month. I know it's not, but it will be. I'm assuming it's for this example. If I request access to the money in the account, the bank will say, that's brilliant. We'll process your request. We will pay that to your nominated bank account in 30 days' time. So it's not quite as flexible as an instant access account, but you do get compensated by a usually higher rate of interest. There are a range of notice periods, so generally they start at around 30 days, and they quite often go anything up to kind of 6 months, to quite often a year. The longer the notice period is, generally the higher interest rate you're paid. So as I said, less flexibility if you go for a higher notice period, but you should get compensated for that through a higher interest rate. Interest rates at the moment are slightly higher than instant access accounts, not massively so. So there is a decision to make. Is it worth potentially tying your cash up for a bit longer to get a slightly better interest rate? I'll come to the interest rates a bit later on, but you can kind of judge for yourselves and make a personal call. Some accounts do allow you to take withdrawals out within the notice period. Not all of them, but some of them do. However, what normally happens is there will be a loss of interest if you do access anything within that period. Normally it's on the whole amount of the cash you have within that account as well. So I might say if you do access this, you're going to lose the next month's worth of interest. So it's kind of, you've got to be able to balance that up. Is, do you definitely need access to the cash? And if you do, you are going to have to sacrifice that interest that you're going to get, or do you have cash from other sources that you can withdraw and potentially keep hold of the higher interest rate? As with instant access accounts, the rates are usually variable. So when you put the money in the notice account, the bank only has to give you notice, the relevant notice that they're going to change the interest rate on it. So if you put money in your bank account, normally the notice period would match up with the period there, the notice on the account. So if you've got a 30-day notice account, it'll normally be 30 days notice the bank has to give you to change the interest rate. So you can essentially request the money back out if you'd like to put it elsewhere. So it's just something to be aware of, that can happen as well. And as with instant access accounts, some of these accounts offer bonuses as well for a number of months. So again, it will act like a floor in the account. So if they offer you a bonus of 0.5%, you'll know that regardless of what happens to the variable rate, you'll have this 0.5% bonus for however many months that the bank's offering that. And then kind of the final type of account is a fixed rate account. Sometimes people call them fixed rate bonds. These are the least flexible account, but on the upside is they also generally offer the highest level of interest rates. So these accounts work by tying your cash up for a fixed period, and normally you either can't access your cash in that time, or if you do access your cash, there would be a penalty on withdrawal. So you'd normally lose the interest for that period. So if you're tying your cash up for a year, you'd normally sacrifice a whole year's worth of interest if you need to access within the fixed term. As with notice accounts, there's a range of fixed periods. Kind of used to be 1 to 5 years, but there are now some longer term bonds than that if you are looking for kind of a guaranteed interest payment over a long period of time. Again, as with notice accounts, the longer the fixed rate period, the higher rate of interest, the more compensation you get for tying your cash up. They generally offer much higher interest rates than instant access and notice accounts. Not as high as they used to be, but generally they're still significantly higher. Unlike notice accounts and instant access accounts, the interest rates are fixed. So when you take out a fixed rate account or a fixed rate bond, you will have that interest rate for the whole term. So if you take out a 5-year fixed rate, see later on, the best rate you can get is 2% at the moment. You will have that 2% for the whole 5 years. So there is a little bit of a risk involved here. If you tie your funds up for 5 years and interest rates increase, you're stuck with a 2% interest rate. Sorry, that's the way it is. Conversely, it could also benefit you if you tie into an interest rate now and the interest rate on offer were to fall, you'd still have that 2% fixed interest rate. So let's say months down the line, you come to look at taking out another fixed interest rate account. You got 2% last month. This month, the best rate on offer is 1%. That's fine. Your 2% is fixed and tied in. So it's kind of a double-edged sword. You just got to be aware that if you do tie in for long periods, that you could potentially miss out on extra interest, or on the flip side, there is a possibility you might gain a higher rate of interest than if you waited or tied in for a shorter period. Next bit is ISAs. Some people treat ISAs as a separate product themselves. They aren't really. They are a tax wrapper. And what I mean by this is any of the previous 3 accounts that I've talked about, so instant access, notice, or fixed term accounts, can be held within an ISA. The ISA itself we call a tax wrapper. So it's not a product in itself, it just infers tax benefits on any product held within the wrapper. So what I'd normally say is if you had an instant access account, that's fine. You can hold that outside of an ISA or inside of an ISA. If you hold it inside of an ISA, then your interest will not be taxed, regardless of what other earnings or tax liabilities you've got elsewhere. Outside of the ISA, there is potentially tax to pay. The table below kind of gives you an idea of what level you start paying in tax on your interest. So if you are a nil or non-remitting taxpayer, you get what's called a personal savings allowance. This personal savings allowance is the amount of interest you can earn before you have to start paying tax on it. So for non and basic rate taxpayers, you can have £1,000 worth of interest before you pay any tax. If that interest is within an ISA wrapper, it doesn't count towards the personal savings allowance. So we quite often find that people have a mixture of kind of ISA and non-ISA savings account. You only need to count any non-ISA interest towards this amount. For higher rate taxpayers, that drops to £500 interest. And for those of you looking to be additional rate taxpayers, any interest you earn outside of an ISA, you will have to pay tax on it. This creates a little bit of an issue for us because quite often at the minute with interest rates the way they are, most people will not exceed the personal savings allowance unless you're an additional rate taxpayer, in which any savings will. So what we've essentially got to do is, rather than make sure we get all of our cash into ISAs, which is what we'd previously recommend before the personal savings allowance came along, is you're more likely to look for what the best rate on the savings account you need is, regardless of whether that's an ISA or not. If you are going to exceed the personal savings allowance, I'll come on to that a little bit in a moment. So I'll give you an example here. So I've got a savings account in an ISA giving you 1% interest rate, and a non-ISA savings account giving you 1.2% interest rate. And you can see if you've got no other savings interest, you're actually better holding a non-ISA cash account to get the high level of interest, as you won't pay tax on it either way, because your interest will fall within the personal savings allowance. So previously, I know kind of in the past, the most common advice has been make sure you get as much of your savings as you can into ISAs, as much of your wealth as you can into ISAs. That's not necessarily always the case nowadays. There is a little bit of a trade-off. One thing I would say is interest rates are historically low at the moment. They possibly could increase in the future. No guarantees that they will, but they could. So you need to have a think about whether it's, do you want to get the highest level of interest now that you can, or would you prefer to accept a low level of interest and get your cash within ISAs and get them within that wrapper, so you know that in the future anything within the ISA won't attract interest. So there is a little bit of a trade-off. Given interest rates are so low at the moment, a lot of people, it is keeping money in non-ISA accounts and getting a higher interest rate. However, for additional rate taxpayers and those where they're potentially going to earn more interest in the personal savings allowance in the future, you've got to take consideration of whether you'd actually prefer to take a low interest rate now to make sure we can ISA everything in the long term. This is my second example. So this is for those that will exceed the personal savings allowance or those who are additional rate taxpayers. So in this instance, I've done the same again. I've assumed that someone is looking to save £10,000, but all the interest they get will be taxable. So I've used the same interest rates for the ISA and non-ISA account, but this time you can see that the non-ISA is attracting tax. Therefore, it's much less beneficial to keep your money outside to get the higher interest rate, as the tax that you'll pay outweighs the gain. So this is something that kind of we need to take into account if you're looking to make savings for most people nowadays, especially those with, like I said, additional rate taxpayers are looking to potentially exceed the personal savings allowance. So this morning I've been online to look for what are the best interest rates that are available now on accounts. So as I said in the last couple of slides, at the minute, non-ISA accounts are giving you better interest rates than ISA accounts across the board. And I've kind of given you a selection there. So I've gone from instant access, a couple of different notice accounts, and then a few fixed accounts. And as explained earlier, as you can see, as you move down the table, the accounts get less flexible. But because of that, you're getting a high level of interest. It's probably quite depressing for a lot of people to look at this, especially those who were saving 10 plus years ago. Interest rates are still very low. When I originally put this presentation together a month ago, they have crept up marginally. There hasn't been a huge amount of change at the moment. And as again, this is your interest rates on ISA accounts. Again, as you move down the table, less flexible, but you get a better interest rate as well. One thing I would say about notice accounts is there aren't many ISA notice accounts. So if a notice account is something you're considering, there are only a few of those available within the ISA. Most of them are non-ISA accounts. There are some, but there's not many. And as you can see, the interest rate on the 30-day notice account is actually lower than the interest rate on an instant access account. I'd always suggest go for the higher interest rate and the maximum flexibility. So in this case, I'd be saying, look, there's no point having a 30-day notice account. You can get a better interest rate, more flexibility from the instant access account. There's a few things to consider when you're looking, a few other things to consider when you're looking to kind of where your savings are going. I'm assuming when you've looked at those tables, the first thing you probably noticed was there's not many names I recognize on there. So if you want a trusted name or a standard high street bank, you would probably be looking to get a lower rate of interest than if you went for the best buy. So you've just got to be comfortable that the institution you're saving with, you're happy to save with. I'll come on a little bit further about compensation schemes a bit further on in the presentation. They are all everything in the slides were covered, but you've just got to be comfortable who you're dealing with. Another thing as well is how you want to deal with the account. So all of the best buys now will be online only accounts. If you want to deal by branch, telephone or post, you're probably looking to get a lower rate of interest than those. All of the best buys were online only operations. So as you add more ways to operate the account, the chances are the interest rate you're going to get is going to be much lower. I was having a look around for branch-based savings accounts, and they are all pretty much next to nil. Not quite, but most of them are quite low if you're looking to open a branch-based savings account. So if you're looking to maximize your interest rate, really think about potentially banking online. If you're not happy to bank online, which I know some people still aren't quite comfortable doing that, then you've got to accept that the rate of interest would be quite a lot lower. Minimum contributions. Some of the best buy savings accounts do have minimum amounts that they will accept into them. So quite often these are at levels of kind of £1,000 or £10,000. Quite often the higher the minimum contribution is, the better interest rate you're going to get. The less that you put into the accounts, quite often the lower the interest rate they will offer. You want to also know when the interest is paid as well. Quite often nowadays, most of the accounts that have been listed pay annually, so they will pay at the end of the year. There are still some accounts that will pay you your interest on a monthly basis, if that's what you prefer, but quite often these come with lower interest rates. And the last bit as well is withdrawals and loss of interest. Obviously, if you're going for a non-instant access account, so a notice or a fixed savings account, you've just got to be aware that if you need access to the funds within the term, there is potentially withdrawals and loss of interest. It's probably worth knowing these before you commit to the account, especially where you're unsure if you might actually need access to that cash. So where can you find these top paying accounts? Well, you can go to a couple of websites I've listed there. It's quite easy if you kind of search on Google top paying accounts. Make sure you miss the ads that come in the first few, and if you go down, but Moneyfacts, Money Saving Expert, and which are kind of trusted resources that are pretty well updated, that kind of give you a good rundown of what the best accounts are. Quite often allow you to kind of input and say, I'm looking to save £10,000, I'm looking for this type of account, and it will kind of bring up the best paying accounts. Alternatively, if you'd like to talk about cash, Advisor Prismatic Wealth are quite happy to do that and kind of help you through that process. If you don't want to kind of do it online, we're quite happy to kind of talk through which accounts might be the best for you, and also kind of point you towards the savings accounts that kind of paying the better rates of interest at that time. So I'll come on to FSCS protection. So that's the Financial Services Compensation Scheme. The slide's a little bit wordy, but it's the important bit, essentially. So if any of the banks that we've listed here fail, or any of the building societies as well fail, and they can't return your deposit, the government essentially underwrites that deposit up to £85,000. So the Financial Services Compensation Scheme will look to pay you your deposit back within 7 working days. The £85,000 limit is per person, per institution. That's really key. I'll come back to that in a moment. For joint accounts, you're assumed to own half of the money in the account each, so you get protected up to £170,000, £85,000 each. There are certain banks nowadays that are part of the same banking group. This is a little bit complex, so stick with me and I can come back and answer any questions on this at the end if you do struggle. But basically, the way banks operate, they get given licenses. Some of these banks that are within the same group have their own banking license. Some banks operate under the banking license of the actual group. If the banks you are saving with, let's say you have £85,000 with 2 banks, if they have their each individual licenses, you'll be protected up to £85,000 with each bank. So you're potentially protected a lot more by the Financial Services Compensation Scheme. However, if you are with 2 banks that operate under one license, then you will only be protected up to £85,000. So that's why the per person, per institution license is kind of very key. So I've got a couple of examples. So Halifax and Bank of Scotland are both owned by Lloyds, and they each have they share a license between them through Lloyds. So if you have £85,000 in a Halifax account and £85,000 in a Bank of Scotland account, and the Lloyds banking group was to go bust, you would only be protected up to £85,000. However, if you're with NatWest and the Royal Bank of Scotland, they're both owned by the NatWest group. However, they each have their individual banking licenses. So if you had £85,000 at NatWest and £85,000 at Royal Bank of Scotland, you'd be protected up to £170,000. So it's really key when you're looking to save, and if you're saving more than £85,000, the key recommendations would be split it between you and your partner if you have a spouse, and then also look to use different banking groups as well to get the maximum protection on your savings. I've got a couple of links there on the slides, which I assume will get sent around after this. So there's one on Money Saving Expert where it allows you to select your bank, and then it will show you every other bank that shares a banking license with it. So you know that if you put any more money into one of those other banks, you would only be protected up to a maximum of £85,000. If it doesn't appear on that list, you're fine. You'll be protected up to 170 plus 85 to every £85,000 to every other bank. And you can also check if your bank is actually protected as well. I'd say this is definitely key. A lot of the best buy tables only include banks that have got Financial Services Compensation Scheme protection. But if it's a name that you're unsure of and that you've never heard of before, that's offering a good interest rate, it might be good to go to the FSCS website just to check that it is protected. We would generally recommend, if it's coming from us, we'd make sure it has FSCS protection. But if you're looking for bank account yourself, I'd definitely make sure that it is covered by the compensation scheme. There potentially are banks out there that are not, and if they were to go bust, you wouldn't get any protection and you wouldn't get your deposit back. That's a potential that might happen. So just making sure that you've got the protection covered. While I'm on getting the best rates for your savings, I've got to really talk about mini bonds. Mini bonds are quite a new phenomena, and they've come around really since bank interest rates have fallen, kind of since the financial crisis in kind of 08 or 09. So kind of rational response to interest rates falling was people have gone out there and looked for kind of savings and investments that would give them a better return. So mini bonds have kind of popped up to fill that space between kind of savings and investments. This has led to many people to invest their money in mini bonds. I've underlined and bold the word invest because this is not a savings account. They are not cash deposits. They act more like an investment. Mini bonds are essentially, you are lending money to usually a single individual company. It's essentially a form of debt. It's not really a savings account. In return for lending that money, the company will pay you an interest on a regular basis, usually 6 monthly or annually. And at the end of the term, you will get your initial deposit back. or initial investment back, should I say. It's not a deposit. One thing I would say about this is they very much look and feel like a fixed interest savings account, but they are not. They come with many more risks. So the first one is if you do invest in a mini bond and the company you lend to goes bust, you are unlikely to be repaid. This is not like when you give your money to a bank and then a bank will lend out to thousands of individuals and different companies. You are more than likely going to be lending to one company. So there's a really high risk that if that company fails, that you're going to lose potentially your whole investment. There's no protection should the investment fail. There's no FSCS protection either. So we have seen cases in the past where after 1 or 2 interest payments, the companies have gone bust and pretty much the people who've lent the money have lost most of their capital. And there is a potential that you could lose 100% of your capital. The company may go bust before making the first interest payment. These investments are what we call a liquid, so you'll probably struggle to sell them if you did want to get out of them. So like a kind of an instant access or bank where you can see your cash and you can go to the bank and say, I'd like to have my deposit paid out to me, please. With mini bonds, that's very unlikely. There's probably no one there willing to buy your investment off. And if the investment doesn't fail, you're only likely to get your money back at the end of the term. So you've got to be prepared to kind of tie your capital up. You will be investing more than likely in either very new or unprofitable companies. And they've probably looked to raise the money elsewhere. So they've probably been to a bank. They've probably been to companies that are looking to raise investments, or kind of some of the companies we use to invest. And they've probably been unable to do so. They would probably only come to the public realistically as almost a last resort. They can't raise money any other way. So you've got to be aware that other investment professionals have probably had a look at this and decided it's not for their clients. And the final thing, there's no diversification. So you're more than likely, if you do invest in a mini bond, you're going to be investing in one company, and all the eggs are in one basket. If that company does well, there's a chance that, yes, you'll get your cash back and the mini bond will pay the interest. But if it doesn't, you basically rely on that company to do well. And I'll also go to cover scams as well, because mini bonds are quite closely aligned to scams. I wouldn't say the scams in themselves, but they kind of usually sold in the same ways. So the main signs of the scams are what's on the slide. So if you see people offering guaranteed returns that are much higher than what you can get on a fixed interest savings account, that's kind of a sure sign. If someone comes to you saying this is no risk and I can give you an 8, 9, 10% return, you don't get 8, 9, 10% returns without taking risks in the current environment. If they offer you guarantees, this will give you your money back and a high return at a certain point. That's kind of a giveaway. Time pressures as well. If someone says, look, this investment's only open for a week, I need to get the money within the next couple of days. Generally, most institutions won't pressure you into investing or saving anywhere. If you're speaking to someone selling these types of investments or accounts and they tell you not to tell other people, or if you tell other people, they might take all the allocation and you might miss out on this brilliant rate. That's kind of a sign as well. Any calls out to the blue or repeated contact as well. Most kind of banks or investment companies generally don't contact you, and if they do, they probably contact you once and not again. So if you're kind of getting repeated calls out of the blue from companies you've never heard of, the chances are they might be involved with a scam. So I know scams are quite a big thing at the moment, and they are in the press. It's just to kind of make you sure that when you are looking to get the most out of your cash, that you're aware that there are people out there trying to part you in your hard-earned. So why do we actually hold cash? Being a little bit negative on it at the moment, but cash is still vital. It's essential. So you need it to pay for your we need that cash there to kind of meet your bills. Unknown future expenses as well. This one's been bigger over COVID. There's things that you want to do, but you might not be getting around to do them quite yet, but you know you're going to do them at some point. So I know a lot of people have been trying to work done on the house and struggling to find trades and things along those lines. You know it's going to cost you a lot of money. You want to keep that money to one side. So we need to make the most of our money. It might be a while before they can come in one payment. So let's get as much return as we can before you're having to pay that out. Emergency funds. As financial advisors, we're always kind of keen on this, that you keep kind of minimum of 3 to 6 months of your expenses in cash, just so if anything goes wrong in your life, you can meet those costs. Diversification. Cash is an asset in its own right. The interest rates might not be brilliant at the moment, but it does diversify other investments and other holdings you might have. So if you have properties or let's say shares and investments within pensions or ISAs, they do provide diversification in times when other investments might be performing poorly. And cash can provide a return. It's not the case at the moment, and it hasn't really been the case over the past few years, but in the past, cash has provided above inflation returns. Obviously, those points might return at some point, but at the minute, that's not the case. So the main risk to your cash is inflation. So this graph, the red line shows what would happen if you kept £10,000 in a 90-day notice account between September 2016 and last month. And the blue is what's happened to the price of goods in that time. So you can see the price of inflation has rocketed somewhat. And if you'd have kept your money in cash, you'd essentially, your money would be buying less now than it would have in the future. So the analogy I use, in September 2016, if you went to the shop and bought a pair of shoes for £100, if you put decided, actually, I don't need that pair of shoes today, I'll buy in a few years' time, you put that £100 in a bank account, you come back in 2021 and you go back to the same shop with your £100 plus the interest you've been paid, and you try and buy the same pair of shoes, the chances are you won't have enough money to buy them now. So that's the gap. So what essentially is happening is the real value of your money that's been held in cash is lower than it was in the past. So this is kind of the main risk of holding cash at the moment. So I checked this morning, and the rate of inflation for the year between August 2020 and 21 was 3%. If you remember earlier, the highest interest rate I could find for a 5-year fixed savings account was 2%. So essentially, the value of your cash is going down by 1% each year if you're holding it in a 5-year fixed term saving account. It's going down more if you're getting less than a 2% interest rate. Inflation's gone up. The previous month, it was 2.1% when I originally drafted this presentation. So you can see inflation's going up quite quickly. And when I looked at the Bank of England's last report, they're expecting inflation to get probably higher than 4% over the next few months. So there's a massive gap between what you're going to be getting returns on your cash savings and what's actually happening to the cost of goods out there. So you've just got to be aware that if you have significant cash savings, the value of those savings are probably going to be eroded quite drastically, potentially over the next few years. One thing I would say is people are very bad at forecasting the future. So these are just forecasts. The kind of figures at the top are what the inflation rates have been, the savings accounts have been, but the forecasts for inflation are very much that. Generally, the longer term the forecasts, the worse we get at getting them accurate. We do have a solution though. While we do need to hold some cash, we don't need to hold so much cash to kind of say, actually, we are going to just have to accept that the value of our savings are going to go down. The solution to that is investing. So this is a similar chart to the one before. So I basically put the red line again is your 90-day notice account. Your blue line is the rate of CPI inflation. And then the green line is our risk level 3 growth portfolio. So we grade our risk levels on a risk scale of 1 to 10. So 1 is essentially you want to take as little investment risk as possible. So you'd be in a cash account. And risk 10 is you're happy to take a lot of risk in order to get a high return. So you'd be invested pretty much 100% in the stock market. So risk level 3 is one of our more defensive portfolios. So it's invested probably, we normally say roughly 30% in the stock market. So you do have some exposure, but the other 70% is in kind of cash and more defensive assets. So you can see over the last 12 years that if you'd invested £10,000 in our risk-free portfolio, you'd now have over £18,000. The cost of goods would be just shy of £13,000. And if you'd have put your money in the 90-day notice account, you'd have just over £11,000. So you can see how if you have a long-term investment horizon, investing can be an answer to overcome inflation. We'd still suggest you do hold some cash. So we'd still say, look, you still need to have an emergency fund there. That will reduce the returns that you get from the portfolio, but we can still outperform inflation. One thing I've got to say is investing does come with its own risks, and that's market volatility. So when I say volatility, that's just the daily movements in the stock market. Volatility can be positive when stock markets go up. It can also be negative when stock markets go down. So the graph here, it shows you what would have happened if you invested £10,000 from the 20th of February last year. the reason why I chose the 20th of February last year, because that's when the stock markets started panicking about COVID, essentially. So you can see that's our risk level 3 portfolio again, and you can see that market volatility was really high, and the portfolio fell quite rapidly when people started concerned about COVID, and we realized that we were probably going into a lockdown. We can compare this to the inflation, the cash account, which were much more steady. Obviously, the cash account just increased along line with the interest rate. There was no change to the actual value held in the account. And then you can see inflation kind of bobbing along in line with it, with the cash account, and then inflation kind of ticked up towards the end of lockdown again. You can see, even though that the risk level 3 portfolio did fall quite significantly, so it's roughly a 10% drop between kind of when COVID happened and the market bottom, we can see how it recovered over the past year. So what I would say is between that March and November, we would hold cash, so we weren't having to disinvest from the portfolio at that point, and then we'd allow your other investments to remain invested. And then markets, as they usually do, and they have always in the past, they've always recovered from stock market crashes and gone higher in the future. That allows you to kind of beat inflation. And you can see that if you remained invested throughout essentially what was the period of COVID, you would be much better off nowadays by being invested than you would have being sat in a cash account. So it's just making sure we have enough cash to kind of overcome that volatility, and also making sure that you're comfortable to remain invested even when markets are falling. So we do have tools to overcome kind of the shortfall between interest rates, the interest rates you get when saving, and inflation. So in the conclusions, how do we actually make the most of our cash? First of all, we've got to make sure we've got a contingency to cover your emergencies. Even though we are getting kind of essentially negative real return on cash, we've still got to hold some cash. That's something we've all got to do. None of us can get away from that. And it's something we've just got to accept that we won't get a brilliant return on this cash. Next thing is find the right account for your circumstances. So if you're quite comfortable that you can tie money away for a long period of time to get a higher interest rate, and you want to access that cash, you can look to kind of have fixed term and notice accounts. If you're unsure and you think you might have some expenditure coming down the line that you know is going to happen but not sure when, you might have to accept that I'm going to get a low rate of interest, but I prefer to have the flexibility of maybe having instant access or a short date notice period account. Getting the highest interest rate possible. I will say this, a lot of the banks have kind of taken people for granted. A lot of people open their first bank account with a certain institution, and then they never switch, and they have all their savings with this bank account. And some of the legacy banks have really taken advantage of this, and they're offering essentially very low interest rates because they know you've never switched before. So getting out there and actually having a look at what interest rates are available and what people are offering is one way to make sure you're making the most of your money. And the next thing is consider investing. If you are holding large amounts of cash, we would say come to us and have a chat about maybe thinking about investments or investing a little bit more. We can kind of sit down and talk to you and kind of explain all the risks involved with investing, and kind of how we're holding for the long term will more than likely leave you better off than kind of staying in cash for the long term, especially the current interest rates. I think I would say if interest rates do change in the future and you can get a positive return, brilliant. But we're fairly certain that at least over the short and probably the medium term, you're essentially going to be losing the real value of your money will be going down if you leave it in cash. That's kind of everything for me today. If you have any questions, more than happy to try and answer anything. And you can also you can either comment directly if you want to turn your microphones on, or you can type comments in the comment box, and Vicky will be happy to read them out as well. So any questions?
Thanks, Jonathan. Have we got any questions? No? Okay, well, thank you very much.
If not, I've just got a couple of last little bits, so
yep.
Let's go back through. So I'm just trying to see anyone's faces if that's a question. So we've got another couple of presentations coming up in November and December. So in October and November. In October, we've got Neil Burrell. He's the Chief Investment Officer of Premier Miton. Premier are one of the investment companies that we recommend in client portfolios. So Neil's the guy who's actually managing our money on a day-to-day basis and making those investment decisions. He's going to be coming in to talk about the diversified range, which is the range of funds that he manages. These funds are quite new into our client portfolios. We've recently started recommending over the last 6 months. So he's going to give an introduction to the range, explain how he's going to be managing your money. He also provide his views on investment markets. So, quite a lot's happening at the moment with kind of fuel shortages and increases in inflation. So he'll probably have quite a bit to say about that. And he's normally a good speaker. And then in November, we have the Bank of England coming in. This probably dovetails quite well with what I've spoke about today. So Gareth Harrison, he's the deputy agent for the North East. He'll be talking about the Bank of England's inflation report that they're releasing next month. So he'll have quite a bit to say about the prospects for where they think inflation is going to be going. And they will probably also be talking about the impacts that have been happening over the last couple of months, kind of with the lack of HGV drivers and the like, and how that's going to impact the economy. Neil and Gareth are both really good speakers, so I definitely recommend, if there's something you're interested in, please do get along. It's not just for clients as well. I would say if you've got any kind of colleagues, friends or family members that you think might find these presentations useful, please feel free to invite them along as well. Either tell your advisor, you can email Vicky when she sends the invites out, or you can contact the reception. We'll be happy to send the invite out to other people as well. All for me for today.
Thank you. Thanks, Jonathan. And thanks everyone for attending. There will be invitations going out for the next 2 webinars, so just keep an eye out for those. But thanks for joining us and have a good day. Thank you.
Thanks very much.
Thank you. Bye.